Hello, everyone, and welcome to this webinar dubbed from KYC to ESG. Maybe a hardcore topic for July month and the summer, but not least an important topic and something I think that has been kind of people are dancing around the topic, but no one is really approaching it. What's actually the difference and how do they converge? So the idea of today is to have a more discussion session with myself, Fanny, and Daniel. So we won't be showing slides, we won't be demoing, we won't be doing anything than discussing. So I hope you can live with that. But I actually think that's going to be a really, really fruitful discussion considering the competences from Fanny and Daniel. And we're kind of gonna go around three themes. One starting out is why KYC ESG is converging. Another theme around what's the reality inside the fund managers, and then a theme around building a unified data structure, data foundation. And I think we kind of everyone has this feeling that there is a problem. And I think especially LPs investors, they don't have a feeling they know there's a problem because they're being approached from several sources about delivering data. And at least me personally, I've never seen kind of like a mapping saying, hey, what's similarities, what's the same data points and what's different data points. So that's some of the stuff we're going to try to dive into today. But before going down that road, I think we should just hand it over for introductions. So why don't we start with you, Fanny?
Thank you so much, Anders, and nice to meet you all. Thank you for inviting me to this webinar. Very happy to be here. So I work at GreenScope. We're a leading ESG solution in Europe. And prior to that, I was working as a consultant in ESG and sustainability, hence my presence here. I've been in charge at GreenScope of, I've been the head of the customer delivery practice for the past 2 years at GreenScope, and I'm now working on our international and European expansion. So very happy to be here and to discuss the future and pending topics on ESG and KYC. Thank you.
Perfect. Thank you so much, Fanny. And Daniel, over to you.
Sure. Thank you, Anders. And thanks to both Avallone and GreenScope for having me on the webinar. It's great to be here. So Daniel Toledano, I'm the head of sustainability at Kilvest Capital Partners. We are a global private equity platform. We manage private equity, private credit, and fund of fund strategies primarily across Europe and the US. And before moving into ESG, I spent years on the investor relations and the KYC side of the business at Kilvest. So I genuinely lived on both sides of the data problem, so that we are here to talk about. So happy to discuss how similar the headaches actually are, and looking forward to bringing that GP's view into the conversation.
Perfect. Thank you so much, Daniel. And I would say you are absolutely the superstar of the show because you exactly know both sides of the problems. Typically, people don't. Typically, you're either kind of KYC for life or you're ESG for life. So I think this is a really, really crucial part of it.
But no pressure.
And then, yeah, no pressure, exactly.
That's my CEO, Anders. I love that framing.
Yeah, exactly. So, and then briefly about myself. Yeah, my name is Anders. I'm a founder and CEO of Avallone. Before that, more than 20 years in corporate institutional banking. The last 7 on the dark side of banking, I usually refer to it. So head of op risk and compliance for Nordea out of Stockholm for 3 years and head of compliance for Danske Bank out of Copenhagen for 4 years. So seeing so much money laundering and KYC frustrations that it's worthy a couple of beers, but I think more importantly, also probably being part of creating the problems that we're not trying to solve, right? So a big part of KYC is coming from the banks and kind of that's where they started in the most high regulated areas. Anyway, now trying to solve it in Avallone, where we focus on more enterprise KYC or complex KYC, KYB, some will call it. Anyway, that's me. So let's kick off with the first theme, why KYC and ESG are converging. And if we start out on your side, Fanny, kind of like what are you seeing on the ESG side right now? Where are the requirements coming from? What's happening on that stage at the moment?
Yes, very interesting question. Actually, so as we see, the data is growing. I think it's a burden for everyone. It's a bit what you were saying in the introduction. It's coming from all places, KYC, ESG. So my answer would be, why is the data growing and why is it interesting? And it's the same reason for KYC. There are three main reasons. One is that the data is more granular. So ESG went from a handful narrative of themes to hundreds of structured, machine-readable data points, and based on several types of regulations. So SFDR, EU taxonomy, even scope 1 to 3 methodologies needed to be detailed. So there are so many more, but this is one key component. A second one is that it's more frequent and there are more angles to collecting the data. So you will have EDCI reporting, but you will have LPs requesting data from you. You will have also SFDR reporting that is well known and that we work on. And all of these increasing the frequency and hence increasing why the data growing. And last but not least, the data is also scored. It's not just collected. And I think it's the same for KYC risk rating, but you will probably say a bit more about this, Anders, later on. And therefore, it's crucial that this data point is a qualitative one because it will be used for several purposes, for scoring, for benchmarking, for different types of reporting. And so this is why it kind of raises the bar on quality. So to answer your question, ESG is definitely evolving towards something that is a bit more consistent and very in that we need to be very precise on. And to conclude, I think what we need to bear in mind are also the regulations. So contrary to what we might think, there are a lot of regulations, and we have heard that there is a sustainability backlash. There is the Omnibus Directive that came into force in March 2026, and that narrowed the CSRD, and therefore there are a lot of companies that were below the threshold and no longer needed to report on the CSRD. But contrary to what we think, there are still a lot of regulations, and even though the CSRD has been narrowed down, this SFDR 2.0 is now shifting into more product categorization regime. There's still the CSRD and ESRS for some companies, the EU taxonomy and the EDCI. Therefore, even though some portfolio companies are now below the threshold, it seems that the pressure has moved from the regulators to the investors that will still need to collect the data at some point. So this is my understanding of things. And I'm curious to also hear about you, Anders, on KYC and due diligence. Do you see the same happening, or what do you feel?
Yeah, it's funny because when you use the abbreviation ESG, it's actually a bigger thing, right? And I would typically put KYC under the G, under governance, right? But people don't. Yeah. It's as if when we use ESG, we're almost like at environmental things and maybe a social, right? But I think it's a huge umbrella, right? And it kind of when I listen to you, it's more or less the same, right? Because I guess it's about transparency. If you really put it up at the highest abstraction level, it's increasing transparency across and between enterprises. So what we're seeing is complexity increasing, absolutely, and that's because it's evolving from KYC starting out being a regulatory discipline, now it's becoming a risk discipline, right? And I think that's the typical maturity you will see. When things start out, you start just reading the text of the law, and then you start to understand, and then you start to think about, hey, what's actually the outcome of this? And then you start to adapt. And I think that's where we see KYC going now, that it's becoming really a risk discipline. And that's also why in the legislation, less and less you can actually read what you need to collect. It's much more around, hey, what's the outcome you're looking for, or we're looking for as a regulator? And then it's up to you to set that process, right? Obviously, as you say, it's been used for risk scoring for a long time. I also think the two-way street is really also a factor now, where 10 years ago you would see banks asking, right? And then other regulated firms, funds started to ask. But now you start to see everyone asking each other and everyone performing due diligence on each other. So fund down to investment target, fund up to investor down to fund, sometimes investment target up to, so everyone is kind of like doing it on each other, right? And I think what's driving it is less regulation. I think the regulation is pretty mature. I think it's more geopolitical uncertainty. And there we in KYC, you have the sanction screening, right? Which is the big no-no, right? So that's why, hey, we don't want to deal with any people that are sanctioned. Obviously, that's the worst case. So we need to understand who they are. But I see also, and maybe that could also be interesting to hear you on, Daniel, but I see also more and more non-regulated firms actually starting to act as regulated firms, right? So again, it becoming more risk discipline than a legal discipline. But hey, let's move to the practitioner, Daniel. What are you seeing? You worked on both sides. What are you seeing in reality out there in the market?
Mm. I'm having sat on both sides. Yeah, I think the underlying problem for me is quite identical. I mean, you basically you are doing the same process. You want to collect, you want to verify, you want to audit the data on the different entities and counterparties, and you want to have a clear audit trail behind all these data points. For me, when I came into ESG, I think the difference I saw was maturity, not really nature of the two processes. I think as you said, Anders, KYC has had, I don't know, roughly speaking, 20 years to standardize the standards, the formats, the checklists, the processes. I think ESG, we are not in the infant phase anymore, but we are still building those reference frameworks. Um, and that's why it feels a bit messier today than KYC. And as you say, Fanny, I think the extra layer of complexity that KYC didn't really have to deal with is the framework fragmentation between Europe and the US. So in Europe, some could say we are very mature. You have SFDR, you have CSRD, you have the EU taxonomy. They are all moving at different speed and different scope, but they are there. In the US, the approach is quite lighter touch, even though I mean, it's shifted back and forth depending on the political cycle. And on top of that, you have different, I would say, angles as well, depending on the strategies. For example, you don't collect the same type of data for buyout fund than for a credit fund or for a fund of fund, even under the same regulation. Um, I think as you were hinting at, I think the encouraging part is that we are seeing some convergence. Things like EDCI, CSRD, hopefully, that are going to push corporates toward a more common taxonomy. But I mean, honestly, I think today it's still fairly chaotic. We are still asking portfolio companies um, uh, kind of overlapping but not identical frameworks, and that's exactly the kind of fragmentation I would say that KYC has solved or tried to solve years ago. So I don't know if it feels the same on your end as on the platform side, Fanny, but yeah, it's still a bit fragmented today.
Yeah, it's true. I mean, so at Greenscope, we're implementing a lot of AI to facilitate the fact that portfolio companies would not have to fill in the same data point for different purposes. But it's true that we have seen, and it's also the customer that purchase, we see that the real complexity is also portfolio companies needing to fill in data, the same information over and over for different kinds of reporting. And it loops back to what Andrews were saying about the multiplicity of stakeholders, what you're saying, Daniel, the multiplicity of frameworks, even though some things are converging. So I guess my question to you, Daniel, would be like who is responsible for the data, who owns the problem, like what is going to take more time on your side, what's the real ESG burden increasing and what impacts does it have for you?
Um, I mean, who owns the data? I think that's one of the key issues you want to solve at the beginning, and that's why it's so much messier when you don't really have tackled that at the beginning, and why it's getting I mean, quite messy. Um, so yeah, it's a matter of governance. It's an issue as well of um, making sure that you have processes in place because what happens frequently, I think, at the beginning is that like 5% own the same data, but not the same version. They don't have the same audit trail. And so you end up with having to reconciliate the same data, and that end up costing you hours and headaches, and hopefully you have to circle back to LPs or to regulator, which is not always a good thing to do. And so that's why I would say trying to solve that issue of having a unified process, unified data lake, unified platform of data helps solve this all this mess. And we've seen that in KYC. I think we are definitely getting to see that in ESG as well. And definitely, if you compare between before we had the platform versus after we have a platform, you still have issues for sure, but it's not the same, and you have you are not in the same category of mess.
Interesting.
Hey, I was just thinking, and this might be a naive question. What's the role of fund admins here? Because I think we've seen in KYC the fund admins sitting pretty hard on KYC data, but not in a necessarily very flexible way. So I think if something funds are learning now is that, hey, we actually need to own, now we're talking data ownership, right, and governance. So we need to own that data ourselves, because otherwise regulators have started to ask, hey guys, do you even understand what you're collecting? Can you access it? And if you can't access it and you have to wait 3 days to get it from the fund admin, are you in control? And now I'm asking, because I really don't know what's happening on ESG. Is there a fund admin move there, or is that happening at all?
I mean, on my end, I haven't seen that, but I'm super interested to have your opinion on this. It's true, on the KYC side, it was quite, I would say, tangential to what they have been doing in the past. So it was maybe natural for them to propose a delegation of those activities to GPs, to GPs. So I think it's very common today to see fund admin who have a dedicated team who are owning the operational side of KYC, even though you still have a compliance team at GPs who oversee that. On the ESG side, I haven't seen that yet. Typically, they would check the consistency of information when you are doing reporting yearly. So to make sure that what you are reporting on ESG doesn't contradict what could be in other part of the financial statement annually. But fund admin getting into operationally managing the data part of ESG, I haven't seen that. But maybe on your end, Fanny or Anders, it's something that you have seen.
So you haven't seen it, but who then will be accountable for the data? You think it's the ESG lead of the fund then, not
Yeah.
the investment team, except for maybe funds that have both financial heads that are also in charge of sustainability, for example, like very earlier stage funds
Yeah.
that have mixed
Dual head.
teams.
Yeah. But I would say I'm not seeing it either, and I think I'm seeing a little bit the opposite move, and that's more related to KYC, because we see now that originally you would do KYC on your investors, right? Now, as the regulators expanding and the risk understanding is expanding, they're focusing more and more on the downstream of funds, so focusing on the investment targets, right? And typically fund admin are shying away from this. They're like, hey, we don't want to do this because it's harder to find a regulatory standard operating procedure to follow, right? Because a target can be anything. A fund, like for you guys, Daniel, a fund of fund, what's actually, so should we then perform KYC on the fund underneath, and then also on the investments underneath that fund? No, probably not. So how far do you go in the chain, and what's the difference when you are a PE fund versus a infrastructure fund? And so the assets are so different, right? So that's why I think the fund admin is like, hey, this is becoming too weird and too messy, right? And I could foresee the same with ESG, because ESG is just such a big thing and less mature, so it's harder to operationalize and standardize, I think.
No, it's an
Yes.
interesting thought. I may be wrong, but so far I haven't seen compliance team either at GP or at fund admin asking for ESG data on investees when you enter into a transaction. Though that may be the case in the future because, as you are saying, both are about risk management. So it wouldn't shock me that you would ask this kind of data from the investees side. So far, I haven't really seen that, but maybe they are just relying on off-the-shelf information that GPs already have, for example, like ESG due diligence. But I am not sure because I think otherwise I would have been informed. But
Mm.
yeah, no, it's an interesting thought.
And now we're talking kind of data points and what's the same and what's not the same. What would you say that you collect in ESG that you do not collect in KYC and vice versa? I mean, I'm just trying to approach the question from because that can also help us identify all the things that are the same. But is there something where you say this is completely two different things in the collection part?
Is this for me or for Daniel?
Anyone? Sorry, I should be more
I
specific.
think Daniel, maybe you have a better
Yeah,
take on this.
yeah. I think the shift on ESG has been done. Initially, it was more about qualitative data,
Mm,
like describe your ESG approach, your ESG policy. Today, because GPs have matured and then the framework on reporting is also, even if it's still messier, I mean, there are certain areas where you know that you are going to have quantitative data. There's been a shift from qualitative data to quantitative data.
mhm,
People ask specific metrics, comparable figures. Um, and so I think the cost is a bit the same as on KYC because you try to reformat the same exact data, the same exact underlying data for different audiences.
mm,
Once it's for an LP report, one is for a bank due diligence questionnaire, one is for a co-investor or for a regulator. It's frustrating because it's genuinely the same data every time, but the packaging is different, and so you spend so much time on trying to map the initial data to the different similar requests, which I think is a bit less the case on KYC because those frameworks are a bit more standard, and so so you spend less time. But I think that today you now have both quantitative and qualitative data, which was not the case a few years ago on ESG.
mhm. Yeah, and I'm thinking in KYC, the special thing, I guess, is ownership data. Or is it? Do you collect that? No, you don't collect that in ESG, right? So
No.
I think that's this thing of trying to understand. You have all of these, especially in funds and in the whole investment world, you have all of these complex structures that are designed for different purposes. But you're kind of all the way kind of trying to understand all the way up to finding some flesh and bone, right? I need a physical person. That's what you're looking for. So it's this kind of a Sherlock Holmes kind of mystery finding, or not necessarily mystery, right? But you're trying to determine who are the
No,
owners,
no.
right?
I
So I
think
guess
you're right.
that's what sets it apart.
I was more thinking about the nature of data, but
Yeah.
you're definitely right. On KYC, at some point, you end up having to ask for very personal data about physical persons. Whereas on ESG, I think most of the data is quite transparent.
Mm,
So you end up on KYC having to manage all these issues related to sometimes the intermediary doesn't want to give you that data at the top of the pyramid, as you were saying, but you need that. So you have to kind of find ways to manage the risk without while managing sometimes the identity of those persons. And that, I mean, that's time consuming as well, for sure.
fantastic. So hey, Daniel, you've tried to come from like on the ESG side, coming from Excel sheets and the very start of it into a more like structured approach. Could you try and share with us and the audience kind of like how did that journey look like for you?
Mm.
That maturity journey?
Sure. Before we had the platform, for sure, like everyone else, we managed data on spreadsheets. And that was the issue I was mentioning a bit before, multiple versions floating around, no real traceability, dependency on a few people. We were the only one to know where the real, the actual version of the right data was. Um, the good thing is that we only did that for a few years or a few months. So it was not about, we didn't have like that legacy, that data lake of data to be transferred, which I think can be a very, very big issue if you've been doing that for years. And so the turning point was a very deliberate choice because we wanted to have a proper platform, not from day one, but let's say day two, rather than accumulating years of technical, I don't know if it's technical debt or data debt, and for paying for that later. So, and we knew the pitfalls from KYC, so we knew that would unlock traceability, version control, which matters a lot as soon as you want to compare data from year N to year N minus one. When an LP, a bank, or a regulator don't just ask you to state something, but also to prove some claims, which makes it a lot easier. So, direct experience that having that audit trail um, turn out what made the big difference between the world pre-platform to the world post-platform, and what could turn into like a how long or days long chase into a 5-minute lookup on the platform, basically.
Mhm.
Yeah, in the end, quality and efficiency, right? Yeah.
Yeah,
Okay.
sure.
Let's move into to the next theme. Or the third theme actually, which we call building a unified data foundation. And Fanny, why don't we start with you, kind of like looking into, we talked a little bit about data governance, but maybe doing a little bit more deep dive on that. How does strong ESG data governance look like in practice, and maybe also what separates well-performing firms versus less well-performing firms in your mind?
Yes, thank you. And actually, just to also jump back on what Daniel was saying, I think it's a very good transition. Daniel very modestly is saying that the platform has helped structure the data process, and Daniel is actually a customer of Greenscope. But a key component and a prerequisite, I would say, is also the data maturity and the data governance, as you're asking me, Anders. And so actually, as you were saying, Daniel, you built on your past experience on KYC to take these good practices and put them in place for your ESG reporting. And what we see is that actually before talking about an ESG solution or having an ESG solution, what's important is to have a strong governance. And the ESG solution will not solve all of your data management problem. So there are basically like 4 questions that you need to ask yourselves, and I will describe them. You could say the who, where, how, and why, basically. So let me just explain what's behind all of these questions. The who is the single ownership. So who has the data? That's what we were saying before. Each data point needs to have one owner and be in one system record. So this is sort of a data management good practice, if I may say. The where is the data? The data is entered once, but it can be used in a lot of frameworks for many different uses. So that's something that we need to bear in mind as well. And then the how is more like, how is the data? What is the quality of the data? Is it consistent? Is it plausible? Has it been verified? Are there some accidents and or errors that we need to correct and that we can spot very easily? And this is facilitated with a platform, but it's important to also define what a qualitative data point is for the fund manager. And the why or the what maybe is where can you trace the data? What is the proof of the data point? So you need to define your audit trail, which is precisely what Daniel was saying, and to know how you can trace back to this data point. So what separates the firms that have a good ESG reporting and those that struggle with it is basically also this governance and being able to put technology above a clear governance and data lake. Otherwise, it could also complexify your data management process. And what we do at Greenscope, which is also interesting, is that we don't only bring technology to our customers, but we also bring a diverse squad of operational data scientists and ESG experts, so that the customers that approach us with different problematic, being ESG reporting, but also governance problematic, because they need to to answer these questions, then we are able to support them and to facilitate the fact that they will integrate the platform, all while having done this prerequisite work.
Amazing. Thank you. It's funny this with sorry, thank
yeah, no, I'm curious to hear about you. So on KYC, do you see the same?
Yeah,
is it more mature?
No, I was just smiling because when you described also that you deliver more than a platform, you also deliver, expertise. Right now on the LinkedIn, it's all over the place that also Palantir is talking about it in data discovery kind of thing, that forward deployed engineers, right? But I think well-performing software providers have been doing forward deployed engineering for many years. It's a matter of selling more than the software, of course. Yeah. No, I think on KYC, we see the same, and especially this talk about data ownership and data governance is coming up. And I think the bigger firms are starting to have like one source of truth, one like pure data lake that they then find somewhere in the backbone. So I think the mature firms are starting to more focus on how does the tech stack look like, and then instead of maybe having the data in different systems, they have it in one system or one platform they own themselves, which is then a data lake, and then they hook up with APIs, right? So that you can actually start to reuse data points. But it requires a little bit more, obviously, right? And it's not necessarily the place to start. But then I think also coming back to like your questions, like what are you actually asking? We're starting to see more and more firms. We've been asking these 55 questions for the last 5 years, right, or 10 years, right? But actually starting to kind of do a revisit and say, hey, does it even make sense? And could we start to unify some processes in one questionnaire or in one process? Which of course then requires collaboration internally, because then you have to reach out, hey, the guys in the tax team, you always ask 9 questions and you, by the way, have 3 forms, and the guys in the ESG team, and then you have the KYC team, and doing that collaboration internally is surprisingly hard, it seems like, which again, I think is just a signal that the governance is not really clear, right? And that you have maybe areas that are moving in non-parallel ways in terms of maturity and what they need to find. But I think the good news is that it also to Daniel's point from before, that you've seen ESG moving from a very qualitative to a much more data-driven discipline, right? I think that's also why in the beginnings you saw head of ESG, they typically came from marketing, which is like okay, which can be great, by the way, no offense, but to marketing people, but you see these trends that typically develop when you then say, okay, ESG is not just a communication thing. It's not just a marketing thing. It's actually real stuff that needs to happen underneath, right? And so I think it's more and more that thing, the people on the team that's driving these things. Hey, Daniel, if you now you've been on the journey, you've been on both sides. You tried to set up a platform on the ESG side and probably also on the KYC side. But if you would be starting a fund from scratch or advising someone, I don't know if you would have the energy for the first one, but anyway, if you would be starting or advising someone that was starting out a fund from scratch, like what would you do there? I mean, this is not necessarily the right thing just to jump on a platform day one, right? But what's your thinking around that?
Yeah. No, good question. I think the real first step before, as you were saying, talking about platforms, etc. I think the real first step is defining the need. Um, Obviously, understanding the frameworks that you see right now, SFDR, CSRD, DCI, all the more local requirements. Um, but also mapping the request that you are currently receiving. That's how we did. So basically, we look at all the RFPs or DDQs from LPs, from banks, from co-investors or regulators, and try to understand where they overlap, to understand all the duplication. Also talking about the peers, talking sorry with the peers. Spend some time talking with other GPs. Also talking with the platform providers because they work with dozens of firms and so normally they genuinely understand, how these frameworks interact in practice. And you don't have to reinvent the wheel basically when you do that. So I think, yeah, the first piece of advice would be trying to map the need and understand the need. And then I think I would go to the process then that you and Fanny mentioned, like governance, source of truth, ownership. Um, Maybe the last piece of advice would be like from day one, try to design for reusability, because you will have to collect and share data that you have collected once for an LP report, for DDQ, for a filing for regulators, and so you need to account for that from the beginning, basically. I don't know.
Amazing.
Does that answer your question?
No, I think it does, and well, it's easier said than done, of course, right?
Yeah.
But no, it's super good. And and also, when you sit in a fund, you are probably bombarded daily with technology providers trying to sell you amazing things, and everything will be easier. But have you also any advice on that selection part? I mean, what are you wary of when you select technology providers, and what are you looking out for? Is it maturity, length in the game, agility, innovation? Like what you want to be careful of?
Yeah, I think the pitfall is related to what I was mentioning. Have you seen already like firms buying KYC technology before they agreed internally, on who owns the data and what data do they need? And I think that leads to a nightmare of an implementation project because you end up like mid-project and really understanding what you are going to need, and so you have to. Basically, you lose months. That never ends well. So yeah, understanding the needs for sure. Um, I remember that for us, one of the things that we wanted was, the main thing that you're trying to do on ESG or in KYC is obviously risk management, and so basically it's how you can downside the risk for you and your investor and your investments, and how you can create value. And I know that on ESG, you are starting to get benchmarking data. And for us, it was very important at the time to be able to tell our investments, our portfolio companies, look, this is your data, and this is what your peers are doing and where they are. And so we wanted to have a provider that could help us, understanding that competitive landscape and give us this benchmark. And I know that at the time it was one of the things that made us choose Greenscope when we became a client. So understanding the need is very important. Um, Obviously, it's a technological tool, so don't work in a silo. We are a very small team in GPs, but now you are working. You typically have also an IT department, so you need to put them into the loop to make sure that these work well with the other technological tools at your firm, and then it's about trying to do it themselves. And I think the fourth part, which is for me equally important, is the fit with the teams.
Mm.
You are going to start to work very closely with your your platform providers year after year. So it's important that you can feel that you're going to have this kind of good relationship because there's going to be like very good moments, but there are also always going to be like some moments where they are a bit more tense.
Yes.
You need to make sure that you have a good relationship for sure.
Yeah,
And we're
fantastic.
happy to have a good relationship
And
with
I
Bill
hope
West
we
as
can
well.
say we have. Yeah.
That's good to hear. Yeah, exactly.
But I completely agree with Daniel. Maybe Anders, if
Please.
I can join to your point, Daniel, I think that it's not tech failures, but it's government failures with a software logo. So once again, completely agree with you. It's about defining the data ownership. It's about doing all of these things that we mentioned before and having the right governance. And so you can expect an ESG solution to fix your problems, but of course it's important to also ask for help if you need to structure your data before starting. And I think a good way to start, and what we see with some of the customers that approach us and that are happy to start their ESG reporting but don't necessarily know where to start, is to start with maybe just with one questionnaire, one framework, and one campaign to start collecting data before you scale and see how it works. See how you can start benchmarking this data, as Daniel was saying, see how you can define a score on this specific framework and data that you collected, and then drive from that. And I think the pitfall would be to have several data lakes and not rely on a clear, good foundation before scaling. So this is what we see.
Yeah, no, good advice. Start small is always a good advice, I would say.
Yeah. What about
Yeah,
you, Anders, at Avallone? Is this something you see as well?
yeah, no, absolutely. And also now I try personally to be both in very large organizations and then smaller ones, right? And we have some of the largest funds and corporate clients in across the world, right? And it's always the same that people want to go from 0 to 100 in the first step, right? So they plan and plan and plan and plan and plan, and then nothing is happening, right? So typically it's also, and I guess that's the agile approach, like, okay, just get started, right? And even if getting started is, hey, why don't we structure the data a little bit better in an Excel sheet, and then we start to work from there, because to Daniel's point, then once you get to buying software, you're actually much more ready and you understand actually what you need, right? So I think that's the more successful partnerships we see. And sometimes we come out to customers where it's like super, I mean, hyper structured, right? But everything is running very manually and they have an army of people doing it. And I'm always amazed about that because it requires a certain brain to set that up, right? That everything is just running, but it's running in like intrinsic SOPs and all of that, right? So it's always a pleasure there, as long as you are not too fixated on trying to replicate that process you have into a platform. Because once you go out and buy a cloud or software as a service, you have to kind of cut a toe or a heel. That's maybe a Danish expression, but you know what I mean. You have to be flexible and saying, okay, this process is maybe a little bit specialized for us. We're going to skip that, but we take the standardized process more and more, right? And that's also where you get economies of scale, because you're in many funds doing more or less the same, right? But hey, let's move on to the last segment, and then into any potential Q&A. We typically try and close these webinars like 5 minutes before, because then people also have a hey, great 5 minutes in a present. But the last one is about what's coming. So kind of like what's the near-term reality, and I think that's extremely interesting in the, I'm going to sound like a record player, but in the age of AI, right? Because it's just crazy, the development we've seen of AI. So and not necessarily only talking about AI, but like kind of like where is it heading over the next couple of years? And if I may start so myself, so just, and I guess you all know that, but like our engineering team, they stopped writing code at Christmas, right? So that's less than 6 months ago. No one is writing code, right? And that's how fast the models have been developing, right? And even though we started implementing AI in the platform a year and a half, 2 years ago, it's just a crazy scale what's happening now, right? So I think also the question becomes really difficult, because it's easy to be naive, but it's also easy to overestimate the development because maybe we are in a bit of a bubble. But it doesn't feel like a bubble though when we see some of the concrete results. So I think actually that standardization is less of a problem going forward for KYC, because even if it's not standardized, you will have engines that can just cater for that complexity, right? Complexity becomes less of a problem. And I think, so that's one thing. I think it doesn't matter whether we standardize or not on the KYC data points. The second part is that I think we'll see more quality because the annoying tasks that are taking time away from senior KYC analysts, they will be done by AI. And then you will see more of these that actually requires thinking, more research, more like, hey, who's that guy? Let's understand this will go up. I think that's just my take on it. But Fanny, what from the other system provider, what's your take on the future?
But it's very interesting because just before, to your point, when you were talking about this, I could see that KYC is maybe more mature than ESG or more present, and so there is this tendency to customize. So according to you, actually, even though we customize, this is not an issue. Like AI will grasp all of this data and make it standardized. But then, of course, the question is, how do you make sure the interpretability is the right one? How do you make sure you trace back to the right data point and you don't hallucinate? So I think these are things that we see at Greenscope while deploying our own AI. Is we try to develop models that were, for example, recently we've developed a due diligence model that can scrap external databases and internal databases and take into account the methodology of the investment manager. So you enter the methodology, you ask how you want to perform your due diligence process, and then you get an IC memo, all the while scrapping as many databases as you can, in addition to what the vendor might have given you on this specific due diligence. And here, our main objective, at least the objective of our developers, is to try to really prepare the databases so that when we look into Greenscope's database, to first analyze and screen the asset that is being due diligenced, it goes and it doesn't make any error in looking for the right data point. And this is done with AI by structuring your database. So we're talking a lot about AI, but data management and databases is as important as AI, and AI cannot work on a data that is not clean. And so even though people can work and prepare their own AI on their side, it's never going to be the same as if you're joining a SaaS, for example, solution that already has an extensive data lake and confidential information on this specific asset that they can share and that will bring you additional information on this asset. So I think this is really where we're trying to go. Yes, and I think AI is a great opportunity also to compare, to benchmark data, to have more context on a data point. We were talking about reviewing the data and making this and having people who are accountable of the data. This will be, I think, the second biggest challenge of AI is how do you review the data that has been maybe read by an AI that has the AI might have shown a lot of inconsistencies on the data point, but how do you train your teams to be able to identify when the AI is not showing the right type of inconsistency and how it has done that, how it has led to this result. So I think, I would say that scrapping information and having more context will be a great opportunity. And our capacity to verify and to understand how the AI got there would also be like a key skill for tomorrow.
Fantastic. Thanks, Fanny. Daniel, what's on your mind? Either future and AI, or maybe that's both the same. I don't know.
Well, it's one of the big topics right now. Not only on ESG, of course. I think you mentioned a lot of the things that were on my mind. Maybe I could also mention the fact that AI hopefully will allow us to interact with data in a much more natural way. Asking question directly, manipulating and cross-referencing rather than manually digging through spreadsheets and every time you need an answer. And I think we are almost there. So I can definitely see this coming, and it will help uh, reduce, I would say, the workload a lot on what you are doing with the data post annual
Yeah.
survey.
Yeah, I completely agree. And I think maybe, I don't know if you all agree on that, but maybe AI will also change. And maybe, Andrews, you have a take on this as well. The way our platform are given or shared to our customers. Tomorrow, SaaS solutions could also be like the backbone infrastructure, and each fund manager might just ask an agent for the data and aggregate all of the different platforms from which the data is present in all of them. And so the future looks very different as well. It's not just going and calling different databases in one solution, but it could also be making all of these solutions consistent and just using one agent to do that.
But I think, but there's so much in this question that would be hard to cover in the next minutes. But I think because for us, when we look at public data, and also what you said about scraping, Fanny, which I think is very natural in the ESG world, in the KYC world, at least in Avallone, we are much more bearish on public data, unless you have public data from a public register source, right? But and the reason I say this is it ties into AI. You have this feeling when you have AI, Claude or OpenAI to formulate text, it's so confident, and that tricks you a little bit. Like, wow, this is really good. It's really confident. But if the data sources it's pulling from is not accurate, it's just hallucinating because it wants to give an answer, right? So I think that's kind of the trick in it. So the underlying data, also to your point, Fanny, becomes extremely important, because if you can give it really high quality underlying data with segregation that's like, hey, you only look at this data, you avoid the hallucination to a big degree. And then you need to train the models that, hey, if you don't have the answer, please don't answer, right? At a certain interval, right, of probability. So I think more. I think more that you will see firms that are these verticals that are niche. They will create platforms that use multiple models, really successful. Because right now we're just talking about the big models, but when you start to look at the big models, there's stuff they do really poorly. And I have an example from our side. So part of the Avallone platform is that you can inject any PDF, any KYC questionnaire, Word document, and it digitizes it. But digitization of a PDF, that's an art form. We learned that in order to get quality, you actually have to use multiple models, also smaller open source models. So I think right now we just focus on the big models. I think there will be a myriad of models, which is good because it is going to drive the token cost down, which is also good for equality of the world, that it's not just a few men in the US earning all the money. So I think it'll be kind of an art form to have the right data and combine the right data with the right combination of models. So that's why you will see more and more, I think, these orchestration layers that are between the underlying models and the outcome you're achieving, and then they're pinging the models in the right way and in the right sequence. That's at least what we're seeing right now, gives really good results. But taking time back a year ago, I would never have imagined we are where we are. And it opens up so many questions that it's hard to predict. But I kind of like sometimes I get scared as well on behalf of my children, but I kind of like from a technology and outcome point of view, I like the direction right now of this in the enterprise space. Any last comments? We are closing in on the hour. There's one question which I think we already answered about data governance. So we talked a lot about that, but let me try and rephrase that and then ask the two of you. If you should point to one person that should own the data in the fund, who should that be? I mean, not by name, but by title, obviously. Who would be the best person to own data across KYC, ESG? Oh, sorry, Daniel.
I think ideally, and maybe we will converge to that. I mean, and that will only come, when we stop treating this as a reporting burden, but when we start treating all this data as an asset supporting value creation, it will sit under, the investment team or the value creation team. Because that's what it is in the end. It's risk management, it's potentially value creation. It's not there for now, but I think ultimately that could be the answer.
Amazing. What do you think, Fanny?
Yes. Well, I agree with Daniel because it's becoming a strategic asset, but maybe just for the sake of the debate, I will say that I think maybe the ownership is the one that produces the data. So, for example, at Greenscope, the way we design the platform is by having a real ownership of the portfolio company. The underlying asset, the person answering the data point is the owner in the end. But then, of course, the ESG manager, and then tomorrow the operating partner, and then maybe tomorrow the head of the fund, because it's become so strategic, is gonna look at that data point. But for me, the owner is the one that produces the data.
Mm. Yeah, good
But
point.
yeah, it's a bit
I,
just for the sake of the debate. What
yeah,
do
no,
you
no, no,
think?
no.
We are French. We like to
Yeah,
debate.
you like the debate. I know, I know, I know. I think we need to go further back, kind of in the stack. I think there needs to be some sort of data responsible in IT. And I know that's been done with limited success in the past, I think. But I think if you find the right person down there around the IT architecture, now we're talking bigger firms and bigger funds, right? But I think some sort of head of data governance or something like that, because then that's the person who can drive through and say, hey, listen, guys, in ESG, I know you have all of these theoretical opinions, but this is how we're going to do it. And the same to the KYC guys that are like thinking they're solving world peace by collecting this. Like, take it down a notch, guys. This is the same data point. You can reuse it, right? But
Like having a DPO or the data product,
yeah, yeah, and then even the
a
DPO is more maybe.
CDO.
Yeah, exactly. It's more like not so much the protection of the data subject, the one delivering the data, but more like internally, like how do we get efficiencies, right?
Yeah.
Okay, we could clearly continue for hours. Fanny, Daniel, thank you so much for joining. It's been a true pleasure. Also for the participants joining on the webinar, and for those listening in on the recording, you are obviously welcome to reach out with any questions or comments to any of us. So if we don't speak before, have a fantastic summer, and thanks for joining today.